I think we shall start. Apparently no technical difficulties today. This is lecture 3. I will maybe say a few introductory remarks just to indicate to you where we are in this little mini course. The last 2 lectures have been, in some ways, introductory material, historical introduction last time, and I guess the first time maybe psychological introduction a little bit. Today I'm trying to do in one lecture what I do in the online course. Some of you know the online course, Economics of Money and Banking, which is on Coursera, which you can audit for free. And the first 12 lectures of that course are what I'm going to talk about today in one lecture, which is the basic fundamental ideas of the money view. The second 12 lectures of the MOOC I'm going to talk about next week in 2 lectures. So in a way, the second lectures are using these concepts to talk about extending them to capital markets and the shadow banking system, and extending them to foreign exchange markets and global money. So that's why shadow banking is on Monday and global money is on Wednesday. So, but the basic concepts are today. And as I say, when I teach these in my normal classroom, I spend half of the semester doing it, and 12 lectures. So this is a bit rushed to do it all in one lecture. And if you really want to pursue some of these ideas, I would encourage you to take advantage of those other materials. But I think it is actually useful to see the whole picture at once, even if all of the details maybe don't all fall into place in your mind yet, because it is the big picture in a way that informs all the details. So if you see the big picture first, it will make the details easier to pursue, and you can learn them on your own. You don't need me for that. There's lots of these materials that are on the web. So I titled today Money View Fundamentals. You have seen this slide many times now so far. This is where I was trying to prepare you for this lecture. We're going to talk about each of these 5 things, but there are 2 big ideas in the money view. One is money as a payment system, banking as a payment system, and the second is banking as a market-making system. And there's some subcategories underneath there, which we'll go through. And I just remind you last time that I mentioned that the way monetary economics and finance have developed since World War II basically has abstracted from both of these things. It's abstracted from payment systems, abstracted from the market-making system. These are not part of standard theory, really, which is maybe fine. This is what theories do. They abstract from something in order to focus on something else. And so I'm abstracting from lots of other things in order to focus on these things. So in a certain way, that means the money view is not really in opposition to standard theory. It really is a supplement, or it's even orthogonal. It's talking about different things, and it's taking a different viewpoint, a different entry point into understanding the system. I remind you last time, I associate some names with these ideas. Morris Copeland, Hyman Minsky, Ralph Hawtrey, Sir John Hicks, and Walter Bagehot. You could associate other names with them as well. This is more just to indicate that this is a tradition that has historical roots, and that there are, and also to honor these people from whom I learned so much that I've been trying to update and make it relevant for modern times. But I don't think of the money view. What I'm going to talk about today is not historical. Okay, it's now. I'm trying to understand the system as it exists right now, outside the window, using some ideas from the past, but updating them for the present. So we begin with the first big idea, thinking about banking as a payment system. And in particular, the first sub-idea, Roman numeral 1, which is we think of the economy as a whole as a money flow economy. Okay. This is may be different from what you've seen in other classes, where maybe you're thinking of the economy as a simultaneous system of supply and demand determining price vector, something like that. Here, this is the basic idea, and this is the accounting structure that was invented by Morris Copeland in 1952. He wrote a book for the National Bureau of Economic Research, in which he was emphasizing money flows. He distinguished between sources of money and uses. Sources and uses, these are flows, and you can see there are 4 different categories here of uses and 4 different categories of sources. The first line there is receipts and expenditures. G&S stands for goods and services. So this is, if you will, the real economy. Okay, so that if you're selling something, if you're a storekeeper and you're selling something, that's a receipt. You're receiving cash. It's a money flow toward you, cash flow toward you. And if you are spending something, that's an expenditure. Spending on some goods and services, that's an expenditure. This we're familiar with in our daily life. Receiving when it's you and me, we're selling our labor. Okay, I'm selling my labor to someone right now, okay, and I'm getting a receipt of some kind for that, receiving some income from that. And you're buying education or the food you need to live while you're doing your education, so these are expenditures. The particular innovation of the sources and uses framework is below the line. I call these are the financial flows that Morris Copeland pays attention to. He was particularly interested in creating an accounting structure for the macroeconomy that would be an alternative to the accounting structures that were already in use by economists. And he felt in particular that they weren't paying him enough attention to these matters below the line. So he's proposing this as an alternative to the national income and product accounts. Okay, with C plus I plus G plus net exports, this is the national income accounts, where standard macroeconomics is built to explain the national income accounts and vice versa. And he thought that this was leaving out a lot of important detail. But he was also thinking of this as an alternative to the equation of exchange, MV equals PT, so the monetarist sort of accounting structure. And he was hoping that we could build some macroeconomics around his own alternative, this sources and uses. And I hope so too. Okay, this is 1952, but that was 60 years ago. Maybe now is the time that we can start to build on some of these ideas. Let me talk about this below the line part, because this is the part that we will be using most, because in a course in money and banking, it's not about the sources and uses for goods and services, it's about these financial flows, okay, that we're going to be focusing on. One way to introduce this is to say, suppose that I'm a storekeeper and I'm selling things, selling more things than I'm buying today. So I have an excess cash flow in toward me. These are the 3 things that I can do with that excess. Okay. Down at the bottom, hoarding, that just means building up your money balances. Hoarding, building up your money balances. So if I'm a shopkeeper and I sell more candy bars than I buy, I have excess cash flow and I just leave it in the cash register. This is hoarding. More generally now, money takes forms other than cash, so this could also be building up your bank account. So any kind of monetary asset is included in hoarding. I could also use that excess to repay a debt. So if I had a bank loan or a personal debt to somebody, I can use it to pull down my loan balances. Or I could use it to buy some financial asset. That's what asset accumulation is. So I could buy a stock or a bond or something like that. So, and you can see from that description that this list of possible uses of funds is meant to be exhaustive. Okay, that includes all the possible things that you could do with your funds, excess funds. Everything falls into one of those 3 categories: either building up your money balances, or paying back debt, or accumulating financial assets. That's in the case that you're a surplus agent. okay, that you have more cash inflow than you have cash outflow. But if you're a deficit agent, okay, so that you have more cash outflow than you have cash inflow, there's this problem. How do you meet that deficit? You know, where does that, what are the resources available to you to fill that hole? Okay, and that's what the right-hand side here is. If you have more expenditures than receipts, then you must either be dishoarding, meaning drawing down your money balances. Okay, you must be borrowing so that you're shifting your payment into the future, so that you're getting cash now from borrowing and then promising to pay it back in the future, or you're selling some financial asset, selling a bond or a stock or something in order to make that payment. Okay. The way this accounting structure works, it's always the case that the total sources and total uses are equal. By construction, okay, that there's a source for every use, there's a use for every source, not necessarily on the same line. This is the point, okay, that there's a relationship between the goods and services above and the financial sources and uses below, but the total adds up on each side to the same number. And that helps in analysis because when we see a use, we can always ask, well, what was the source? When we see a source, we can always ask, what was the use? That helps for thinking about individuals. It also helps for thinking about the macroeconomy. As I said, Morris Copeland was interested in trying to do economics of the system as a whole using this structure. And this structure has another wonderful property, which is that every use for one person is a source for someone else. Right? So if I am making an expenditure, I'm buying a good or a service, someone is selling that to me, and that's a receipt for them. Right? If I'm buying a stock or a bond, somebody is selling a stock or a bond. So that's accumulation for me, it's decumulation for me. If I'm dishoarding, spending money, then somebody must be getting that money and they're hoarding. So it adds up across the economy as a whole, okay? That all of my sources are somebody else's uses, and all of my uses are somebody else's sources. So there's a kind of, this accounting structure is meant to bring to your attention what we talked about last time, the way in which the economy is this interwoven structure of promises to pay and actual flows of payments. This is focusing on the flow of payments at a moment in time. These are flows, and these accounts also have a stock formation, meaning you can look at the balance sheets and say, what are your total asset positions, what are your total liability positions, and how are those changing over time? When they construct them, that's what they construct these accounts. So these accounts are constructed at the national level for most countries now. In the United States, certainly. I'm sure Poland has flow of funds accounts. Most countries have some version of them, but what we have not done is to develop much theoretical understanding using this set of accounts, and that's what I am proposing to do a little bit today. Last thing on this slide, this bottom bullet point here, these words that we're going to come back to, monetary liquidity, funding liquidity, and market liquidity, are referring, I want to line them up with this accounting structure, that when you are a deficit agent, okay, and you need liquidity, you need to fill that spending gap, okay, monetary liquidity refers to filling that spending gap by using your reserves of money, okay, dishoarding. Funding liquidity means filling that liquidity gap by using your credit line, by using your ability to borrow, right there. And market liquidity means filling that gap by using your available financial assets, selling them or maybe using them as collateral for borrowing or something like that. Okay? So these three forms of liquidity and the interrelation between them are going to be part of the story. In fact, I'll come to the end to an argument that one of the important things to understand about the evolution of the monetary system since World War II is that we've moved from a system which was largely focused on monetary liquidity, so that people met their payments by using their money balances, okay? And we developed all monetary theory around the idea that that's the only way to do it, okay? And then the system changed, and people start meeting their liquidity needs with funding liquidity, and then people start meeting their needs with market liquidity, and now all three of them are available, but the theory hasn't caught up to this fact about the world. So that's what we need to be doing. That's why I say standard economics very much talks about money supply equals money demand, as if everything is about monetary liquidity, and kind of misses the substitutes, these other methods, which we're going to talk about. So I'm spending some time on this slide because this set of accounts is an attempt to, is a quantification of a money view. It's trying to view the economy as a whole as a set of money flows between agents of all different kinds. This is a very general accounting structure. The last slide I showed you last time, remember, was I mentioned that Minsky, I was referring to Minsky and saying that he's viewing every household, every agent in the economy as if they're a bank, a cash inflow, cash outflow entity. Whether it's a household, whether it's a business, whether it's a nation, whether it's a bank, this accounting structure is perfectly general. You can use it for anyone like that. Think of every agent in the economy, and so as a consequence, you don't have to have a different accounting structure for firms or for households. It's the same one, okay? You can view the whole, or even for different countries, everyone can be fit into this, and so you can think of the economy as a whole as a money flow system. That's the idea, okay? I'm just going to give you an example of how we might use this accounting structure to look at a particular microeconomic transaction. I talk about this one. This is the exact same example I use in the course. You can see on the video. I'm thinking here of a case where I am going to a local restaurant in New York City called Mehrling, which no longer exists, but it exists when I made the lecture, and I liked it a lot, so I like to remember it in my lectures here. And I'm buying dinner there. Okay, and so that is. An expenditure for me. So this is the top thing, the blue thing, is the goods and services account. Okay, so that's an expenditure for me and a receipt for Mehrling. And now we can use these rules, sources and uses rules, to say, well, if that's an expenditure for me, that's a use of funds. What is my source of funds? And in this example, I'm saying that I'm using a credit card. I'm using my MasterCard. And if you think it through, what does it mean to use your MasterCard? It means that I am borrowing from MasterCard. Okay, that I am now going to owe money to MasterCard later on. So that's in this borrowing category here. Borrowing from MasterCard is my source of funds. Okay. And what is Mehrling using its receipt for? The receipt is a source of funds. What are they getting when I sign the credit card to them? What are they accepting in payment? It's not money, so it's not hoarding. It's not repayment of some loan. It's an asset. It's an asset. Now, when I sign my credit card bill, it means that MasterCard now owes money to Mehrling. That's how it works. So I'm treating that as accumulation of a financial asset for Mehrling. So this is my source of funds. This is Mehrling's use of funds. And again, using this idea that my source of funds is somebody else's use of funds and Mehrling's use of funds is somebody else's source of funds. Who is that somebody else? Obviously, it's MasterCard. So there's MasterCard over here, okay, which is borrowing from Mehrling, okay, and accumulating an asset, which is my debt here. Straightforward. This seems like a simple, even trivial little example, but it's just to show you that you can build up any level of complication using these basic concepts. You can break down any transaction into these basic concepts and figure it out. And in fact, I think until you break it down into these steps, you don't understand it. You don't really understand how it's going. So it's useful exercise when you're thinking of something to try to reformulate it in balance sheets, in sources and uses, so that you make sure that you really understand it, and so that you understand it in the context of the money flow world. Okay. So I'm going to continue using that example in a minute, but now I want to introduce the second concept, which is the survival constraint. The survival constraint, which we've talked about a little bit so far, it emphasizes the time pattern of cash flows and cash commitments, and the necessity in each period to settle. Okay, that if you're a deficit agent, you have to find a source of liquidity to meet that deficit. That's the settlement constraint. And this is a constraint that binds deficit agents, not surplus agents. Okay, it's a surplus agents. Yes, all sources have to find uses, but they can sort of they're free to choose. You know, the store that is selling more than it is spending can always just accumulate cash, right? It doesn't have to really make a decision. It can just accumulate cash and wait. Okay. Whereas somebody who's building up debt has to do something. They have to find a way to meet that spending today. That creates discipline in the structure. This discipline of final payment. And it's an asymmetric constraint binding deficit agents. One way to meet that constraint for deficit agents is to borrow. That creates elasticity. So the payment in reserves, that's like monetary liquidity there, okay, can be postponed. That's what credit does. It says, yes, I will pay you, but I will pay you tomorrow, okay, or I will pay you in 10 years if it's a long-term loan. And that postpones, it's a delaying of the day of reckoning. There's different kinds of borrowing. Some are secured with some collateral or other. Some are unsecured. It's, again, an asymmetric constraint. It's not automatic. You have to get someone to lend you that money. You know, the creditor has to agree to this. Sometimes, like in MasterCard, they agree ahead of time. You know, they give you a line of credit. They say, I've looked at your situation, and yes, I'm willing to lend you up to $10,000 line of credit on your credit card, or if you're a student, maybe $1,000. So credit relaxes the discipline, this survival constraint discipline today, but it tightens that discipline tomorrow because there's an interest rate typically involved here. So that the privilege of not meeting my bills today costs me something. And as a consequence, as a debtor, I'm still facing that discipline. Credit doesn't relax this discipline, okay? It just postpones it, okay? And it makes it tighter in the future. I emphasize this discipline because from a money flow point of view, this is why the market economy kind of acts as a coherent entity, okay? Why it's not just chaos and anarchy, okay? It's the discipline of settlement that makes people think about here I am, I'm a little cash inflow, cash outflow entity. What is my position in society as a whole? Well, I can find that out by just watching what happens in my wallet, okay? Is it going negative? In which case I have to adjust. I have to say, something's not going right. I have to adjust my activity relative to the society that I'm engaging with. And that's not just for me, that's for you, that's for everybody. Okay, that this activity of daily settlement is a key organizational feature that makes the market system cohere. And we don't maybe like it. You know, to be disciplined is, you know, nobody likes being disciplined. That's the nature of the system, and we put up with it because not only am I being disciplined, you are too, okay? And I kind of maybe want you to be disciplined, so I have to put up with discipline for me in order for there to be discipline for you, and that's what makes the whole system work. This is very general, and it can, you know, sometimes there can be too much discipline, sometimes there can be too little. We're going to come to monetary policy and all of that sort of thing in time. I'm building up from very basic concepts, but very general concepts that are applicable to all systems. So far, so good. The survival constraint. And I'm attributing this to Minsky. I mentioned yesterday. This was a word that he used in his doctoral dissertation, which he wrote for his supervisor, Schumpeter, talking about this settlement constraint. And I was, when I saw that, when I was doing some research on him, I realized that's a central idea to figure this out. So now let's think about settlement of our little case, my little example of going to the restaurant, where I've satisfied my survival constraint at the time I had my dinner by borrowing from MasterCard. Okay, and MasterCard lent to Varelli, and that's how that whole thing went. So I postponed it. I pushed it off into the future, this settlement constraint. Now the future is here, okay? And we're looking at what happens. And I'm showing the settlement constraint, I'm showing the settlement constraint that is confronting MasterCard in the very first place, because the restaurant, having made a meal and sold it to me, it wants to actually get paid. It's not interested in financing MasterCard and lending money to MasterCard. It lent money to MasterCard so that it could sell this meal. But now it wants to get paid, and maybe the very next day, or even with smart terminals at the very moment, a couple of minutes later or something like that. So typically the way credit cards work, the settlement with the merchant is what happens first, okay? And I'm showing that settlement with the merchant, okay, as that Varelli is selling their financial asset, they're liquidating that financial asset, for cash, for hoarding, for money. And MasterCard is repaying Varelli, so they're drawing down their loan balance, they're repaying their loan by dishoarding. So MasterCard has a bank balance somewhere, or maybe it is a bank, okay, in which case this dishoarding may actually even be creating money as a liability of the bank, but it would still count as dishoarding because it leads to Varelli hoarding here. So the MasterCard settles its debt with Varelli by transferring money. So that's the survival constraint sort of in practice confronting MasterCard, because MasterCard owes Varelli some money. And the next step is me, okay? That maybe at the end of the month when I get my MasterCard bill, and typically the bill says your minimum payment is $25, even though a typical MasterCard bill for me might be $1,500. As a good economist, I try to pay it in full every month, okay? Because the interest rate is very high if you don't pay it in full. MasterCard would like you not to pay it in full so that you incur these interest rates. So let's assume I pay it in full. And I do that in the same way that MasterCard paid Varelli, by dishoarding from some money balances there. And there's MasterCard is liquidating its asset, which is my debt, and hoarding. So this little example, which I've gone through in some tedious detail, shows a lot of things about the credit system. It shows the way in which credit moves the settlement constraint into the future. It shows the way in which credit separates the settlement of when the merchant gets paid at one time and when I do the payment, which is another time, maybe much later. And there's this intermediation of MasterCard in the middle that basically gives each of us the cash flow that we need. It helps us match up our cash inflows and outflows by using credit, allowing us to relax the daily settlement constraint. If we had to pay with everything in cash and receive payment everything in cash, it would be much harder to organize this thing. And that's why Varelli likes credit cards, because that means I can buy the food even if I don't have any money, okay? They like that. And I like it for the same reason. I can buy the food even though I don't have any money. And we can each get the money and deal with the money part of it kind of later on when it's more convenient for us. But the discipline is still there. The settlement constraint is still there. It's postponed, but not forever. It costs something to postpone it, and it costs more to postpone it more. This is the point, that the credit card is expensive to me. So that discipline is something that I feel and create in my life. And if I don't pay attention to it, it will catch up to me. You know, this balance will get bigger and bigger and bigger, and then they will cut off my credit, and I will be back in a world where I can't do this anymore. So, settlement mechanics. So this is a sort of microeconomic example. Now I want to just shift to a higher level in the system and appreciate the way in which this same mechanism is being used for wholesale settlement between banks paying each other when the withdrawals from one bank, when they're a deficit bank at the clearing or a surplus bank at the clearing. And I'm showing the way this works in the economy as a whole. Now I'm shifting to not sources and uses, but assets and liabilities, so that you can compare. Think of this as the balance sheet of a bank. And think of this deficit agent as some bank that is, at the end of the day, the people have written more checks on its accounts, okay, than it's received checks from as deposits, and so it owes to the clearinghouse some $1 million, $10 million, something like that. It's a big bank. But just by the logic of the system, it has to be so that there's another bank out there somewhere that's in the opposite position, okay, that is a surplus agent, that has received more deposits than it has paid out. At the end of the day, the clearinghouse, the role of the clearinghouse is to keep track of that. You know, who owes who what, and who is a net debtor and who's a net creditor. So this is showing the expansion of credit during the day in order to facilitate payments. Okay, just as we just saw with Varelli, how MasterCard facilitated an expansion of credit in order to make this payment happen between me and this restaurant. This is more generally the case in the world, in which clearinghouses on their own balance sheets are expanding credit to banks, facilitating, and that makes it possible for banks to provide credit to me, you know, and everyone else, so that that the bank itself may be a deficit agent, and so they need to worry about the discipline that is confronting them. During the day, there's no discipline. It's elastic. That's the point. You can do anything you want. You can accumulate large deficits on the clearinghouse. But at the end of the day, the settlement constraint comes into effect. You need to meet your payments with reserves. That's the idea. Reserves are hoarding and dishoarding for banks, is accounts at the central bank, this idea. And if you don't have any reserves to pay, then you need to push that constraint off into the future. You need a credit card of some kind, okay, to push that constraint off into the future. What are the credit cards for banks? Okay, it's the wholesale money market. That's what the wholesale money market does, okay? Overnight loan market in Fed funds, in repo market, Eurodollar market, there's a number of different kinds of money market assets, money markets that are engaged here. And I'm just showing here that the deficit agent is replacing its debt to the clearinghouse with a debt to this surplus agent, that they're meeting in the money market. Okay. The surplus agent goes to the money market because they say, look, I have this excess, let me not leave it at the clearinghouse, okay? Let me invest it in something. This deficit agent, though, has the requirement. I have to settle with the clearinghouse. I have to find somebody to lend me reserves so that I can settle with the clearinghouse today. And it goes out and it borrows in one of these markets, and it borrows from the surplus agent. It has to provide conditions, it has to provide terms that the surplus agent is willing to accept. So that's the interest rate, and it's also the form of borrowing. So what does the surplus agent want? Do they want to lend in the Fed funds market, in the repo market, in the Eurodollar market? It depends on who they are, where they are in the system. What is the rate they're willing to pay? Depends on who they are, so they're meeting. This is what's happening in money markets. Money markets are playing that role in pushing the survival constraint for banks off into the future, maybe just one day, okay, overnight. But that might be enough, because possibly tomorrow the deficit agent will be a surplus agent. And maybe tomorrow the surplus agent will be a deficit agent, and so that will naturally just resolve that credit, and it will collapse again. So here again, there's an expansion of credit overnight, but that credit is due tomorrow. The discipline is there, okay, and there's a relaxation of the settlement constraint today, but a tightening of it tomorrow because there's an interest rate associated with it. So this same idea that I just gave you about in the retail world, me dealing with Varelli, the same idea is happening at a higher level in the system when banks are settling with each other, and there's no goods and services exchanging at all. All of this is what I call below the line. This isn't about goods and services at all. It's everything that in the financial accounts there. What happens if the surplus agent and the deficit agent can't come to terms, or they can't find each other, or the money markets are disorganized in some way, so that the deficit agent cannot obtain the means to settle? Okay. liquidity kills you quick. They'll be kicked out of the clearinghouse. They'll be kicked out of society, about the ability to engage in this money flow world. That's where the central bank kicks in, okay? That they can always settle if they can get central bank liabilities. That's money. That's money for banks, right? That's the reserves. So the central bank has its discount window saying, if you for some reason, after best efforts, trying to find someone to lend you money, okay, to settle, I will lend you money, says the central bank. I will lend you money if you bring me good assets that I can use as collateral, and if you're a bank in good standing, and I know who you are. And so they're watching. They have credit lines here. And what that amounts to, how does the central bank do that? Essentially, by taking this position here of the clearinghouse onto its own balance sheet, so that the central bank creates new reserves, okay, and lends them, which it gives to the surplus agent, and it lends them through the discount window to the deficit agent, okay, at a high price. Typically, the discount window price is 100 basis points over the Fed funds target. So it's saying if you can't do business at in the Fed funds market, okay, I'm here, but it's going to cost you more discipline, right? More discipline, so that you understand this is always a balance between elasticity and discipline. Credit creates elasticity. It allows us to meet this settlement constraint when we don't have enough money to do it, but it pushes it into the future and it makes it harder in the future. So we don't want to do that unless we have to. Or we can balance that out. So it's the same issue like my credit card, that if I can't pay the whole balance, I'm going to face 25% interest rate. So it's just like the central bank here. So you see the same principle operating in the wholesale world, in the retail world, and in fact internationally as well. We could do. We'll talk about that later. I think I've mentioned this before, but just to remind you, when we are in the money view, when we're emphasizing the settlement constraint, this is very much paying attention to the time pattern of cash flows and cash commitments. It's not about leverage. It's not about how much debt we have. It's about when the debt is due. Okay, so I have a mortgage for my house, but it's a 30-year mortgage, okay? So it may look as if I'm incredibly leveraged because that mortgage is multiples of my annual income. But I am not required to spend my annual income amortizing that mortgage, only a portion of it. My monthly payment is a fraction of my of my monthly income, and so I am actually a hedge agent in the mortgage market. I'm showing here just an example of supposing an agent has a cash flow, expected cash flow inflow of 10, 10, 10 in periods 1, 2, 3, 4, 5, and think of three different kinds of agents, all of whom have liabilities of 25, but these liabilities are arranged in different ways. That one makes a promise to pay 5, 5, 5, 5, okay, in the 5 periods. 1, 10, 10, 5, 0, 0, and 1, 25, 0, 0, 0. Okay, you can see that 25 is a lot bigger than 10. So somebody who has arranged their debt in that way cannot pay their debt. Okay, they are forced in period 1 to borrow more money. They have to borrow more money, or if they have some assets, liquidate some assets, because there's no way with their cash inflow. They're going to be a deficit agent. They're going to be a deficit agent, and they're just going to have to go into the money market, or in some ways roll over that credit. So they are at the mercy of the creditors. If the creditors don't want to lend them, or say, we're going to charge you a high rate of interest, that's the nature of the thing. Whereas the hedge agent is not. The hedge agent is a structural surplus agent here. They have 10 coming in and 5 going out, so they're on the other side of that transaction. They can say, I have 5 extra. Okay, and if you want that 5 extra, you have to give me terms, okay, that I'm willing to take. The survival constraint is increasingly binding as we go down this diagram, even though the total debt is the same and the total leverage is therefore the same. So that's just to emphasize that what the money view emphasizes is the time pattern of this. Not the aggregate debt and the aggregate cash flow over time, but do they match up in time? That's the issue. And you can see that if you added all this up, it looks like everyone's in good shape. Everyone has total cash flow of 50, total outflow of 25. Everyone looks like they're fine if you just add them all up. But if you look at the time, not so, okay? Mr. Ponzi down here can possibly be in quite big trouble, whereas Mr. Hedge up here cannot be in big trouble. Okay. So that's a consequence of emphasizing the survival constraint, that you pay attention not to debt equity ratios, but what kind of debt, when does it owed, and what is the cash flow against which this is a claim. All right. So I've been going slowly there because these are basic concepts and that we need to get into our heads. Now let me just tell you some of the, this is before we shift to the next idea, banking as a payment system, the way in which survival constraint facilitates economic coordination in the economy as a whole. I mentioned this already, but now I'll go through it in a little more detail. That if you are an agent and you are facing deficits at the clearing, at settlement, that's a market signal. That's telling you that your cash flows and cash commitments are misaligned. It's telling you something. So it's a signal. Economists know about market signals. We're used to thinking of prices as a market signal. You know, it tells you, does the economy want this good you're producing or does it not? Prices are a market signal. So in the money view, it's not prices, it's quantities that are signals, and it's quantities at the settlement. Okay, are you a deficit agent or are you a surplus agent? You know, this is the signal. But it's not just a signal, right? It actually is an enforcement mechanism. Because if you're a deficit agent, you can't just say, "Oh, that's a nice signal. You know, I'll make a note of that." You can't. You have to actually do something. You know, you have to settle at the clearing, and you have to do that, and the surplus agents don't. Okay, there's a discipline there that is enforced by the creditor lending decisions. If you want to push your settlement constraint off into the future, you have to get a creditor to agree to terms. And that forces deficit agents to reconsider, am I doing the right thing? Am I running my life the right way? Am I running my business the right way? It's not just a signal, it's not just, nanny saying, you're not running your business the right way. It's nanny saying, settle, come. This is the end of the day, and you promised to pay, and now how are you paying me? How are you paying me? And if you don't pay me, that's it, you're cut off. No more food for you. This microeconomic coordination also, there's a macroeconomic, once we push up to the higher level, element of that, which is that the money market rate of interest. I've mentioned the money market rate of interest. I've said you have to, if you're a deficit agent, you have to convince surplus agents to lend you money, and one of the ways you do is by offering them a rate of interest. There are a whole bunch of deficit agents, right, at any given time, and there's a whole bunch of surplus agents, and there's a money market, and there's arbitrage in this money market that creates a market rate of interest. Okay, it's not a bilateral negotiation, right? It's a market price, the money market rate of interest. And yes, if you're a bad credit, you're going to pay the money market rate of interest plus, okay, and if you're a good credit, you might pay just the money market rate of interest, but still, there's a market level of interest rates. And that interest rate, this is the theory of interest that comes out of this way of thinking, that the rate of interest reflects the society-wide imbalance between cash flows and cash commitments. Okay? It's not a rate of time preference coming from some delta in our utility function. Okay? From microeconomically, it comes from the realized imbalances in cash flows at the moment. This is the overnight rate of interest we're talking about, not the long run rate of interest. So misalignments of market-wide cash flows and cash commitments push money market rates up or down on their own, and that has consequences for other prices because the rate at which you can borrow today or for short term creates arbitrage with other prices, other financial prices in the economy, and has effects on the whole structure of interest rates. And so we're going to come back to this slide, but just think about this, that there's this misalignment of cash flows and cash inflows and cash outflows, causing the overnight interest rate, the cost of putting off the day of reckoning for one day, okay, that's what that is, to move up or down. But there are these other longer-term interest rates that are going to be affected by that. In particular, the price of time. So there's a term structure of interest rates. There's overnight, there's 3 months, there's 5 years, there's 10 years. There's a relationship between this overnight rate and these longer-term rates, and there's a speculation. I can borrow short and lend long, and there are speculators doing all of this. So shifts in the overnight rate are going to ripple through the whole structure of interest rates. We know about this theory of the expectations hypothesis, right? That the long-term rate of interest is just the expected sum or multiple of all of the short-term rates of interest out to the distant future. We know that fails empirically, okay? That it's not true. It's a nice theory. It seems like it should be true, but it's not true, okay? That short rates are in general lower than long rates on average. And so the term structure doesn't work. One of the things the money view explains is why that might be so. We're going to see that that's a liquidity premium, and what exactly do we mean by a liquidity premium? Similarly, there's a structure of interest rates around the world. So this is the first now I've indicated that this money flow system is not just national, it's global. The money market rate of interest is not just national, it's global. There are money rates in every country, okay, and they might not be the same. You know, the overnight rate of interest in Europe and the overnight rate of interest in the United States and in Japan aren't necessarily the same, but there's going to be some arbitrage between them, that you can borrow in yen and lend in dollars, and that's going to influence foreign exchange as well. There's this thing called uncovered interest parity, which you would think in arbitrage that it should be so that if you borrow in yen for a day and then pay back in yen, that somehow at the future foreign exchange rate, that should somehow be the same as just borrowing in dollars and repaying in dollars. There should be an arbitrage there. That's uncovered interest parity. That also doesn't hold in reality. Why not? Okay, there's a liquidity premium there we're going to talk about. And there's another pattern of interest rates that we might think of, which is about, I was speaking just before about the tiering interest rates, that the interest rate that you pay and the interest rate that I pay and the interest rate that a AAA bank or a AAA corporation pays, these are not the same interest. Some of this is about default risk, okay, that we're not considered the same credit worthiness. And you might imagine that you could peel off some of that default risk and sell it with a credit default swap or something like that. So we might imagine that this tiering of interest rates is reflecting default premiums. You know, that's what it is, that the probability of default is just aligned with this difference in interest rates. I call that the unbiased default premium theory. And it's analogous to the uncovered interest parity and expectations hypothesis. And I think it also is not true, okay, that people pay low quality credits pay more than the unbiased default premium. There's a liquidity premium there as well. So we're going to see, we're going to see some of this when we come to market making, the theory of market making. This is meant to prepare you for that. This slide right now, the point is just to remember that the imbalance between cash inflows and cash outflows today moves the overnight interest rate today, and that ripples through the entire world, through time, through space, and through the risk structure of interest rates. Tomorrow, again, it moves and it ripples through. The next day it moves and it ripples through. This is the mechanism through which the macroeconomy itself, the level of imbalance, is signaled to everybody. Not just my imbalance, not just am I a deficit agent, do I need to do something, but is the macroeconomy in general in balance? You know, are cash flows and cash commitments aligned in general? And if not, these are messages that are sending that we need to correct something. And that leads us then to policy. From this point of view, monetary policy, okay, which is, let's think about open market operations, you know, buying an asset, buying a treasury bill with an expanded Federal Reserve balances, okay, that makes it easier for somebody to sell treasury balances in order to meet their commitments, to meet their survival constraint, right? So monetary policy, from this point of view, works by relaxing and tightening the survival constraint. And that will have direct consequences for the money rate of interest. If it's easier for people to meet their survival constraint, deficit agents that strengthens the position of deficit agents. You know, they don't have to bid for money from creditors because they're getting it from the government, from the central bank. So it lowers interest rates. Fiscal policy, where we're doing things with taxes or we're giving money to people through subsidies or something like that, the government is actually spending, that's a cash inflow, right? That's a cash inflow for the people receiving that. And that makes them less likely to be deficit agents if they're, because it's a direct cash inflow, depending on what they spend it on or how much they spend it. So that's going to have indirect consequences for the money rate of interest because it changes the pattern of cash flows. So we can start to insert government policy into this money flow by thinking of its consequences. What does monetary policy actually do for this cash inflow, cash outflow feature of individual agents? What is its distribution across the economy? Who is having their situation improved? Who's having their situation worsened? Who finds themselves with more elasticity? Who finds themselves with more discipline? So this is a different way of understanding fiscal policy and monetary policy. We tend to think of this in aggregate terms, right? Something, money supply equals money demand, or you know, taxes equals expenditure or something. Here I'm saying we in order to understand its consequences for the economy, you think about which balance sheets, you know, which are going to be affected and how. So that's just preview a little bit already, and all we have here is just by focusing on the settlement constraint. That's all. We're just thinking about payments. That's all. I've waved my hands a little bit about, oh, this is going to affect money market rates of interest, but I haven't really explained how or anything like that. I've appealed to your intuition about supply and demand, which now I will unappeal to, and I'll go into more detail about that. These are dealer markets. These aren't supply equals demand markets, and that's where we're moving next, with banking as a market-making system. So let me pause, have a drink of water. So the second big idea is banking as a market-making system. Shift gears. And I begin by reminding you, you've seen this diagram before, I think in lecture 1, that we think of the monetary and credit system as a hierarchical system. Under a gold standard, gold is the best money. So when we think about hoarding and dishoarding, if you're a central bank, hoarding and dishoarding involves gold hoarding and dishoarding of gold, because that's what money is for them. If you're a bank, hoarding and dishoarding means currency or liabilities of the central bank. That's reserves for you. For me, hoarding and dishoarding means liabilities of the banking system, deposit accounts. That's money for me. So there's this hierarchy of money and credit for different agents. This sources and uses way of understanding the world works for every level, but what counts as credit and what counts as money depends on who you are. Okay, that for me, money is a liability of the banking system. For banking system, money is a liability of the Federal Reserve, and so forth. That's familiar. We've done that before. What I want to draw attention to now, okay, is the right-hand column. So thinking of central banks as market makers in the exchange rate. That price comes from the fact that central banks are straddling two layers of this hierarchy. They're issuing liabilities, currency and bank reserves, okay, and they're holding as assets gold, and there's an exchange rate between those two things that they are managing in some way or other. Banking system is issuing liabilities, cash, and holding deposit accounts, and holding cash, liabilities of the central bank. They are promising par. They're promising to maintain one-to-one between that. They have to manage their business so as to do that. How do they do that? This is part of the thing we want to talk about. Security dealers down at the bottom, we're actually going to start with them because the theory that I've evolved comes from originally thinking about how do security dealers make markets in stocks and bonds. Okay, they are accumulating inventories of stocks or bonds, or they're going short. and they're converting stocks and bonds into cash, right? That's what a security dealer does. They give you a bid-ask spread. They say, I will sell at this price, I will buy at this price. I will sell at a high price, I will buy at a low price. That's the bid-ask spread. And depending on the order flow that comes in, they find themselves either buying on net or selling on net, and then they can change those prices in order to change those order flows. So they are clearly market makers. And so we start with security dealers because that's a familiar idea. One of the things that the money view does is to take the theory of the economics of the dealer function that comes from thinking about the market microstructure, how security dealers work, and say there's an analog to that or an extension of that for money market dealers, okay? And there's an analog or extension of that for foreign exchange dealers, okay? That it's the same function, it's just different assets, okay? And so we can use this theory at all levels of the hierarchy. But let's start at the bottom. Oh, I forgot to tell you. This is another important thing to just as a setup. This hierarchy is a pyramid, right? There's a little bit of the best money at the top and there's a ton of credit down at the bottom. And it is fluctuating over time. It's getting wider at the bottom, and that's the period of elasticity. I've mentioned that before. And then in periods of crisis or recession, it shrinks back down again. I mention that in order to just foreshadow that these dealers who are standing between the layers of the hierarchy, okay, are under stress when there's a contraction. You know, there's elasticity and there's contraction. They're straddling between layers of this hierarchy, right? One leg here and one leg here. And when the hierarchy gets steeper, you know, they're straddling farther and farther. That's when you start to see these intermediaries running into trouble, banking crises and so forth. That it becomes harder and harder for banks to maintain par. And maybe they need a bailout from the central bank or something like that. So this is an image I want you to have in your mind. That's why I did it with my legs here, okay? That I'm a central bank or I'm a bank and it becomes harder and harder to do this. And maybe I just stop, okay? And if I stop, then the ability to sell at the lower level for something in the higher level stops. It's the dealers that make that make it possible for us to sell credit and for money, somebody like that, and at a good price. Here's the model of the economics of the dealer function that I have used for teaching purposes. There are other versions of this that have algebra associated with them, but I think this helps to understand. I give the name Hicks for his wonderful 1989 book, The Centrality of the Dealer Function, but he doesn't mention this model. Okay, his book is entirely verbal, but just 2 years before that, Jack Traynor wrote a very nice little article called The Economics of the Dealer Function, and that's where this diagram is coming from. And I'll just quickly do this. If you want to really understand this, you're going to have to learn the model and play with it. But the important thing to appreciate, there are three things associated with this model. So this is thinking about the economics of a security dealer. So a dealer that is maybe trading in Apple stock of some kind, is quoting a bid-ask spread for Apple stock. And what I'm showing here in this diagram is on the horizontal axis is the dealer's position in Apple stock, okay? Do they have inventories, positive inventories, a long position in Apple stock? Do they have negative inventories, short position? Okay, in Apple stock, they're down there. So that's short, that's long. And there are limits, position limits that I'm putting there as the vertical axis, which may have to do with the dealer's risk aversion. It may have to do with its access to bank credit to fund these inventories. It may have to do with any number of things. And they may not be hard and fast limits. There may be soft limits. But it's a model, right? We're used to this. We're economists. It's to sharpen ideas. That's one thing. So there's on the horizontal. On the vertical axis, this is the price of Apple stock. And I'm showing here the inside or dealer spread. So when I say the bid-ask spread, that's this, okay? There's a high price at which I'm willing to sell and a low price at which I'm willing to buy, okay? That's the bid-ask spread. And that bid-ask spread, you can see, depends on the dealer's inventory. So it's showing that if the inventory is here, okay, that's the prices that are being quoted. Where do those prices come from? The way the model works, it says that the dealer, that there's somebody else, some deep pocket investors, okay, who the dealer knows about, that are willing to buy if the price gets low enough, the value-based bid. So this is Warren Buffett, okay? This is that sort of trading strategy. Real money investors, okay? Not dealers, real money investors who are making the so-called outside spread, that they are willing to buy if the price gets beat down below value quite a bit. And there are people who are willing to sell. If the price gets bid up to a crazy level, they're willing to go short. And the dealer is making the price in between those two. So there's an outside spread here, and the dealer is operating inside that outside spread and moving the price depending on their inventory. So if they quote this set of prices and their inventory rises so that they start to move to the right, they lower the price in order to slow that selling, okay? If they quote this price and their inventory moves to the left, they raise the price, okay? So this is the economics of the dealer function. They're a profit-making institution. They want to buy low and sell high, okay? Either right now, there's order flow now that I'm buying low and selling high, but also over time. I'm buying low now, okay, and hopefully selling high later when the order flow changes. So this image of the dealer is playing a role as balancing supply and demand. That if supply and demand don't equal each other, the dealer steps in and takes the other side and changes their inventory, right? That's what that means. That if the flow of people wanting to buy Apple stock is greater than the flow of people wanting to sell Apple stock, the dealer sells out of its inventory or goes short. That's what it means to set a bid-ask spread. I'm willing to do business, and I will take the other side of your trade, whatever it is. For now, and I will change that price, if I don't like the results, but I'm committing to do that right now. So this idea is often hard for economists to grasp right away because we're used to thinking that prices clear markets, okay? That the price moves until supply equals demand, okay? What are dealers doing according to this? They're actually preventing prices from moving as much as they would. That if there's a surplus supply, okay, prices should fall. It shouldn't be the dealers absorb this fall in inventories. The prices should fall until somebody's willing to buy it. Okay. And in the other direction, prices should rise. Okay. So that supply equals demand. In fact, though, that creates a profit opportunity for somebody to act as a dealer to say, well, I think that at the moment there's a little excess supply, but I think it's temporary. Okay. So if I absorb that excess supply now, I will make a profit. So they stand in between and prevent prices from moving as much by creating fluctuations in their own balance sheet. They're absorbing in their own balance sheet fluctuations in the imbalance of supply and demand. And in doing so, they are creating market liquidity. So that if I want to sell Apple stock, I'm a deficit agent and I want to sell Apple stock, I can sell without having to worry about finding somebody who wants to buy. Because the dealer is going to buy. The dealer is going to buy. And so I can treat Apple stock as a liquid asset, something that I can sell if I need to raise cash to meet my own survival constraints. So that's the link between market making and the settlement constraint here. Okay, let me say, here I'm drawing it again, a link between funding liquidity and market liquidity also. Okay. That if I'm putting here 0 on the horizontal axis, where the dealer has neither a long nor a short position in the stock, and I'm calling it matched book because it's possible in some markets you might have long position with some agents and a short position with other agents, and so it's the net that is a matched book. The net is 0. It may be you have gross positions. When you deal with fixed income markets or swap markets or something like that, you need to deal with that. Supposing that you have a positive inventory here, you have to finance that in some way by borrowing. by borrowing from banks. So that's funding liquidity, right? In our sources and uses, borrowing is funding liquidity. So in some sense, what dealers do is they convert funding liquidity into market liquidity. That they're using their ability to borrow to buy inventories, which provides market liquidity to people who have those stocks. So there's a relationship between funding liquidity and market liquidity. And we're going to see that's important for financial crises and so forth. Sometimes people who are in this business think that they convert market liquidity into funding liquidity, but that's from the other side. They're doing that for the people who they do business with. Now, just a little aside on this. In fact, let me go back to this diagram here. Remember, I just said that what the role of dealers, and it's not something that they're assigned to do. They're doing this for profit, to make a profit, is to absorb on their own balance sheet fluctuations, imbalances between supply and demand, temporary imbalances. However, prices do move. Okay? So you might think that there's some like true value of this stock, okay, that is based on the true prospects of Apple. And you might think that maybe that is where supply actually equals demand, so the dealer is not doing anything. The dealer has a matched book. So you might think the true value is somewhere in the middle here, okay? The efficient price or something like that. You can see that dealers in general are quoting prices that are not the same as the true price. Okay, and so this theory of market efficiency that we're used to in finance, if markets were efficient, there would be no dealer profits. Okay, if prices were always equal to their true value, the only way that could be is if dealers are always willing to buy or sell exactly at true value. Okay, in which case there's no profit for them. There's no bid-ask spread, and when there's imbalances between supply and demand, you absorb them for free. Okay, dealers don't work for free. Okay, so this idea that there's a dealer in between supply and demand has an interesting relation to the theory of efficient markets. It says that markets are inherently can't be efficient in order for there to be a subsidy for markets, in order for market makers to be willing to do their job. Now, it might be a very small subsidy, and it also might be a subsidy that you can't arbitrage. Okay, the only way you can get that is by being a dealer. Okay, so it's not that prices are inefficient and that leads to a profitable arbitrage. No, the dealers are doing that profitable arbitrage. Okay, they're doing that profitable arbitrage themselves. And anyone who's doing that profitable arbitrage, this is an important point, is a dealer. Okay, so I'm not, when I say dealer, it's important. There's a group of people in the world who like set up their, in this business, and they put on their business card, broker dealer, okay? I'm talking more generally, okay? Anyone who engages in this trading strategy is supplying market liquidity to the world. Whether they call themselves a dealer or a day trader or whatever they call themselves, they're supplying liquidity to the world. And that's the function that I'm interested in. Not whether you call yourself a dealer or not, okay? But whether you're doing this sort of trading. And that's key in creating prices. This is where asset prices come from. It's from this sort of behavior. The ability to buy and sell bonds, the ability to buy and sell stocks. And this is also where money rates come from. Okay? It's just banks doing the business in 30-day paper or something like that. This is where interest rates come from, and even overnight rates as well. So this is what I mentioned. Let me just repeat what I was just saying before, that price in general is unequal to value on account of dealer expected profits, but the dealer function does play a stabilizing role, absorbing in quantity inventories what would otherwise have to be absorbed in price. So when in dealer markets, prices don't move as much as you might expect them to, but they do move some, and they move away from value in order to give the incentive for dealers to absorb these fluctuations on their balance sheets. Oh, here's a couple of these arbitrage relationships just to have in mind. Before, I was using words for thinking about the expectations hypothesis and so forth. Now I'll use numbers so that we can be clear about quantification of this. So there's this concept called forward interest parity, which is the idea that the forward rate of interest, that is to say, let me just explain my notation here. This is the forward rate 3 months from now going to 6 months from now. So this is the rate at which you can lock in a borrowing or lending rate that starts in 3 months and goes for 3 months. Okay, that's a forward rate. People quote forward rates separately, and there's an idea that it should be, this equation should hold, that this is the spot interest rate from now for 3 months, this is the spot interest rate from now for 6 months, and that there's a relationship, that it should be so that I can, if I lock in the 3 month, the forward rate here, and this spot rate here, essentially I've locked in for 6 months a borrowing rate, so it should be the same as that. That's forward interest parity. Okay. In general, that's riskless arbitrage, and so we expect it to hold, and usually it does hold. I'm going to come back to this. Okay. In disordered markets, it may not. The expectations hypothesis is the idea that this forward rate should be an unbiased expectation of the future spot rate. That's a way of putting the expectation. And as I said, that fails empirically. It fails reliably empirically. It always fails. Okay. Why does it fail? The idea that banking is a market-making operation is a possible explanation of that. That it fails because there would be no dealer who's going to make that market. You know, they're not going to do it for free. Okay, they need to be paid, and so somebody who is borrowing short and lending long, that's how you would take advantage of this. Okay, is expanding their balance sheet, is absorbing imbalance in payment flows. And that's liquidity premium. Dealer expected profit is the source of liquidity premium. So that's the first 2 bullet points. The second 2 bullet points are just saying the same thing about foreign exchange. That there's covered interest parity, which is riskless arbitrage that you would expect to hold all the time. Negative basis trade means it doesn't. We're going to come back to that next week. Which is to say that the foreign interest rate, this is the current spot foreign exchange market, this is the forward foreign exchange market, and this is the domestic interest rate here, that it should be so that the forward interest rate, okay, satisfies this equation. Otherwise, there's a riskless arbitrage, and in general that holds. What uncovered interest parity says is that forward rate should be an unbiased expectation of the future spot rate. And that does not hold. Okay? That's another one of those things that you think should be true because it seems like an arbitrage, but is not true, is never true. The data always show that it fails. And the money view suggests one reason why this might be so, that there's a market maker there that has to be paid in order to carry that position. And dealer expected profit is the source of the liquidity premium that makes that not work. There's another version of this. There were these 3 things that I talked about, right? Time, space, and risk. You could do the same thing for credit default swaps. And why are credit default swaps not actually efficient expectations of future default rates? Okay, it would be the same story there. But it's not on that slide. And because I sent these slides a week ago, I couldn't add it to the slide. So what do dealers do? I just gave you a little sort of theory of dealers. Now I'm just going to play this out a little bit. Call a normal crisis. A normal crisis, what I mean by that is an imbalance between supply and demand. Okay, that's just a normal crisis. And I'm showing in my balance sheet structure here that what households want to do is sell securities and for money. That's as a whole, households want to do that. That's why there's an imbalance. Some people want to sell, some people want to buy, but on average and in total, in net, households have just woken up in the morning and said, Apple? I don't think so. I want to sell Apple. Okay, and they want money for it. The way this works, the way they get money for it, is as follows. Okay, so I'm putting the dealer now into a macroeconomic structure that you understand. The dealer is quoting a bid-ask spread for Apple stock, and so when they sell their Apple stock, what happens is that the dealer inventory rises. The dealer takes these securities off of the market onto their own balance sheet. And that's something that needs to be financed. They're spending more than they're earning. They're a deficit agent in this operation. How do they fill that hole in their settlement constraint? They have lines of credit with banks. Okay, so they're borrowing from the banks, and the bank is creating this money in general. This is the alchemy of banking that I referred to, just by expanding their own balance sheet. All right? So this money, this liability of the bank, it's deposit account, but it's monetary asset, is the same money as there. So so I'm including now banks as part of the dealer system here. That when society as a whole decides it no longer wants to buy Apple stock, the price of Apple is going to fall. Okay, but not as much as if the dealer, because of the dealers and the banks, that the dealers are absorbing some part of that imbalance on their own balance sheets for money. The dealer is buying that security at less than its market value, hopefully, if they're right about this, okay? And they're borrowing, and the bank is being paid interest, okay, to finance that. So both of these agents are doing this for a profit, and they're doing it to satisfy this shift in portfolio demand that households have, that they want to dump this stock. And so in normal crisis, now this might happen in the morning, and then in the afternoon, households say, no, actually we were just freaked out. We really do want to buy Apple. Or it was just the people who were scared who acted first, and the people who are not scared act in the afternoon. So it could all be reversed, okay, by the end of the day, and all of these positions go away. This happens thousands and thousands of times in the markets every day. That's why I call it a normal crisis, that the dealers are absorbing fluctuations, time fluctuations of demand of demand and supply for a price. What we call a financial crisis is just a more extreme version of that. Just a more extreme version of that. And a version of that that is large enough that dealers are unable or unwilling to absorb it on their own balance sheets. Okay. So I'm showing again, households decide, and maybe they decide it's not just Apple stock I don't want any stocks. Please sell, right? And if everyone says sell, who buys? Okay. Ideally, the dealers would buy and the banks would finance that. But if they say everyone wants to sell, I'm not willing to be the person who catches the falling knife. Then the central bank steps up. And if the dealers are unwilling to expand their balance sheets, perhaps because the bank is unwilling to expand their balance sheet, the central bank gives a little word to the banks. It says, if we will lend freely to you, if you will lend freely to the dealers, if they will support this market for the time being. So there's a third layer, that the central bank is acting as a backstop for the banking system, which acts as a backstop for the dealer system, which acts as a backstop for the market for these securities. Okay, so this hierarchical arrangement where you have the best money, reserves, the next best money, okay, and the third best money, you're walking down this hierarchy, and it's the top of the hierarchy that is supporting the bottom of the hierarchy. That's lender of last resort. In this last global financial crisis, this is what the Federal Reserve did first of all. Okay, I showed this in this diagram, that the Fed was selling off treasury bills in order to make loans to dealers directly, in order to make loans to banks. Eventually, that wasn't enough, and the central bank actually operated as a dealer itself. That's dealer of last resort. So I'm showing here, the households are selling securities for deposits, and how's that working? It's because the central bank is buying those securities, giving reserves to the banks, which are using them as deposits for the households. So that the central bank became a dealer. Look at the balance sheet there. Securities on one side, reserves on the other. Okay? Look at that balance sheet. Securities on one side, loans on the other. It's the same balance sheet. So this is the central bank acting as if it were a dealer, because the dealers have stopped. See that? Nothing on there. No balances on the dealer balance sheet here. So a financial crisis is just a more extreme version of what happens every day, an imbalance in supply and demand, so extreme that the dealer system breaks down. And this backstop that normally doesn't have to be involved, right? I showed you a normal crisis. There's no central bank here, right? It's just the central bank is a backstop, but it's not actually doing anything. It's just there in the wings, making it possible for banks to do what they do, make it possible for dealers to do what they do. In effect, the central bank is making the outside spread, okay? But you haven't hit that outside spread. When you hit that outside spread, the central bank comes into action, and then even more comes into action here. This is a financial crisis. Now I want to shift, we just have a few minutes left, to thinking about the policy again and the economy as a whole. You may remember last time when I was talking about monetary Walrasianism and standard monetary economics, which is thinking of the world as a Walrasian general equilibrium, and I quoted James Tobin saying that if all prices moved freely, there would be no leverage for monetary policy. That's not a direct quote, but that's sort of what he said. So what I'm pointing out here is that, but he has a model that's abstracting from banking as a payment system and abstracting from banking as a market-making system. So it looks to him like if you have freely moving prices, you have no leverage. Okay. Now I'm showing you the money view does not abstract from those things. Okay. The money view puts those things front and center. It puts the payment system front and center. It puts the market-making system front and center. And once you have those things front and center, you realize that even when you have freely moving asset prices, the central bank has leverage over the economy. We saw that. That's why I talked to you about crisis. It's very clear that it has leverage over the economy, right? It's making markets when no one else is making markets. Okay, so it has leverage even in normal times too. Okay, it has leverage because I talked to you before, because its own liabilities are the final means of settlement. So that's why it can manipulate the overnight interest rate. Okay, because it can manipulate the survival constraint. Okay. And it can also manipulate the availability of credit to dealers, and so therefore their willingness to make markets and move asset prices and things like that. So the central bank has leverage over the economy even if there are no frictions, okay? Because there are these two frictions that are in all market economies. Settlement constraint, okay, which binds. And dealers make markets. So it's not supply meeting demand, it's supply meeting dealers, dealers meeting demand, that the dealers are standing in between. And by influencing the dealer balance sheet, you can influence the economy as a whole. So monetary policy does work, okay, even in a world of freely moving financial prices. And here's how it works. By changing the overnight rate, and dealers themselves are then transmitting that overnight rate over time, over space. We were talking about that. This is just to remind you, I used this slide before when I was talking about the way that the Fed was imagining monetary policy would work in this important report in 1952. And I'm saying that's how monetary policy does work, as a matter of fact, in the economy as a whole. Here is just a way of imagining it. This is my own handwriting, sorry. I need an assistant to make beautiful slides for me. Anyone want to turn this into a beautiful slide, just email it to me and I will give you credit. All this is showing is just a monetary transmission. The idea that in normal times, the central bank is moving the overnight rate. Okay, and that's about the balance of cash flows and balance of cash commitments that it can change by involving itself in the repo market, expanding the money supply, contracting the money supply. So it can, and I'm showing here the same dealer model. It's upward sloping here because now we're talking about yields instead of prices, but it's the same idea that it's the Fed can, because it's involving itself in that overnight credit market, can move that price around. That overnight credit market is the source of credit for dealers, private dealers, that are making term interest rates, okay? That are borrowing overnight and using it to finance holdings of longer term repo, longer term commercial paper. So this is where the 30-day rate comes from. And then here's the price of long-term bonds. Other dealers are borrowing 30 days and buying long-term bonds. So that's how the price of overnight gets transmitted through the economy, by changing the incentives for dealers to borrow short and lend long, and so forth. So I waved my hands about that. Moving the overnight rate then ripples through time and space. I'm showing you here just the way that it ripples through time. Okay, from overnight to 3 months to 10 years, through the economics of the dealer function, through dealers responding to the cost of funding and expanding or contracting their balance sheets accordingly. This is my story of monetary policy transmission that emphasizes market making and settlement. Okay, this is not a story about the money multiplier that you might have heard about. This is not a story about banks making more loans and affecting the real economy. This is immediate. This is today. This is every day as the overnight rate is fluctuating. It gets transmitted into the whole pattern of rates. There, the whole pattern of rates. The time, space over risk. The central question that I'm thinking about now, and that maybe we'll think about next week a little bit, is so there are these deviations from the expectations hypothesis, from uncovered interest, from unbiased default premium, that I'm saying are liquidity premia, that are expected profit for dealers. The question for policy is, what should that liquidity premium be? Is there an optimal rate? Should it be high? Should it be low? Should it sometimes be high? Should it sometimes be low? Can we manipulate that in order to stabilize the economy? That's the stabilization framework, I think, for thinking in the modern world. We're going to see next week about the negative basis swap in foreign exchange markets. We're going to see the way that central banks are starting to work out a way to manage this. This is about managing global money. And we're in early days now, and I'm trying to suggest that this is maybe a possible framework to use in thinking about that question. Maybe I can skip over that. We already talked about what is a financial crisis. I'm emphasizing that a financial crisis is a liquidity event. Okay, I already showed you that, where there's more people wanting to sell than people wanting to buy. And that's an unraveling of the backstop of the entire market system. I talked about the institutional evolution of liquidity. We're going to talk about shadow banking next week. So this is the last slide. This is just a foreshadow of the next lecture, that I'm going to talk about shadow banking, past, present, and future. And I am thinking about shadow banks as a balance sheet that looks like this. It's money market funding of capital market lending. Those are residential market-backed securities. This depends. Once you put dealers in the center of your attention, the point is that both sides of these balance sheets are prices that are determined in dealer markets. The funding markets are global money dealers, are creating the price of funding, okay? And the price of capital assets are created in global risk markets, derivatives, credit default swaps, interest rate swaps, foreign exchange swaps as well. So that in understanding the global system, we need to understand the economics of these dealers, global money dealers and global derivative dealers, using our economics of the dealer function. That's how we're going to understand shadow banking, is understanding the economics of the dealers that are making the markets on both sides of the shadow bank balance sheet. But that's just for next time. Okay, I think we are out of time now, just exactly, so let me call it to a close. Thank you.